Welcome back, ladies and gentlemen, to another episode of Zoomer Economics. Mike here. And if you're really into personal finance and witnessing somebody like me, a 22-year-old in New York City, dealing with the reality of being financially independent, well then, go ahead and hit that subscribe button. And if you enjoy this video, please give me a like down below. It really helps me grow the channel. I also have my main channel over here where I actually did a video about my brand new desk setup that you can check out. There's still more to come there, so make sure you go subscribe there, subscribe here so you can see the content that I produce with it, and I really hope to see you be a part of the Zoomer Economics team. I want to address in today's video, should you start investing in the stock market in these crazy times? Now, if this is something that you've looked up before, you've probably heard some people say, it's always a good time to start investing. The sooner you start, the better. And there has been plenty of studies showing that people who wait usually don't gain as much as people who just start and consistently go for it. Buying and holding stocks is not a new idea. It's not something that has just been invented, and it's not something that I am a genius for knowing about. It's just something that people have been doing. You hold on to an investment, and if you really did your research and you believe in it, then it's most likely going to grow. But how do you do your research? How do you know if something is a good investment when the economy is getting beat up left and right by all kinds of good and bad news? How do you know where to start? Where do you put your first $10? Where do you put your first $100? How much should you even start with? Is now a good time to invest your money? Let's talk about that. So I have a couple of friends who know that I've been recently dabbling with the app Robinhood. Now, if you look over my shoulder here on my brand new ultra-wide monitor that you can see a video of on my other channel, that's my Robinhood portfolio. And as you can see, it has dipped very low and has come back up. And it is actually in a downward trend again. So are we going to see the same type of drop? Are we going to see a 30% drop in the next 3 days? I don't know. I don't know if anything can come out that is going to be good enough news to bring us back to normal. I don't know if anything is going to happen that will completely knock us back down to our lows and maybe even further. So, me saying that, I am just some random guy on YouTube. I am just some random dude who has been trying to get their finances in order and wants to help other people. But I am not comfortable telling anybody to start investing right now. I have a couple of friends who have come to me and asked me, Mike, I really want to start investing. I see what you've been doing. I hear a lot of good things about it. Where should I start? Or I have a couple of friends who come to me and they show me their portfolio on some app where they put $2 into something. And it really makes me happy to see that there are other people out there who are at least being exposed to the ideas. But it also really shows me that a lot of people have no idea what the stock market even is. So I feel like it's something that I can help anybody just get a general idea, get a small functioning step. So after you hear what I have to say, you might be better off and sent in the right direction on doing your own research. The main question that I really get though is, where do I put my money? Where do I start? And for every single situation, I always say the same thing. I can't tell you where the best place to put your money is. I can tell you where I've put my money, and I can tell you where I've seen other people lose a lot of money. I can tell you what has been consistently a bad idea, such as jumping into call options. And I can tell you very confidently that trading options is a bad idea. It's not something that you should be doing if you don't know anything about the stock market. I hardly know anything about options trading. The one thing that everybody can agree on, though, is that it's very risky. There's a lot of risk. So, if that's a bad option, what is a good option? Well, I've done other videos about ETFs, an exchange traded fund. An ETF is a really good way to diversify your money. More baskets to put your eggs in. You never put your eggs in one basket. If you have more baskets, like in an ETF, then your money is a little bit safer as opposed to purchasing one single company. If you put all your money into, for example, Tesla. Tesla is something that right now is extremely volatile. It could go way up. For some people it has. But if you have no idea what you're doing and you don't know how to time anything, nobody can time the market perfectly. So you're not going to be able to either. Putting in your money just because you saw somebody else gain money is not going to get you anything. It's really putting yourself in a bad situation. So, how can we find out if it's a good time? How can we gauge the risk? And how can I start my early Robinhood portfolio or whatever brokerage you decide? But if you do decide to use Robinhood, please use my link in the description below. You will get one free stock and it will also really help me out, so I get a little bit of a kickback with my own free stock. So share in the glory with me. I really appreciate that. For the most part, a lot of people usually when they come to me and they say, where do I start? They don't know what any of the things on the app even mean. They couldn't tell you why a graph has gone up or down, and they couldn't tell you what a ticker symbol is. They couldn't tell you what a dividend is. They couldn't tell you what an ETF is. They couldn't tell you what a PE ratio is. So these are people who are assuming that you put your money in and more money comes out. But what I'm here to tell you, and what I'm hopefully going to be instilling into many of you, is that you have to do your research and you have to understand the fundamentals first. So when I jumped into this, the first thing that I bought was something very simple. I put money into Bank of America because I knew that I've been using Bank of America my whole life and they've been doing well for me. So I put in $30. Then from there, I got into a couple of other things like VOO. VOO is an exchange traded fund, an ETF. It's pretty much something that represents the overall 500 top trading companies. So if the top 500 companies on the market are doing well, then that ETF will go up. There are many like it, and there are plenty of different ones that can try to follow the overall market. If you wanted to put your money into one single company, like I did with Bank of America, just as my first willy-nilly thing, then you're probably going to end up with what happened to me. I put in $30-ish, and before I knew it, that money went way down. And then I held on to it for another week, and sure enough, I got my $30 back, and I pulled out immediately because I started putting my money into other things that were a lot more safe, ETFs. As for specific companies that I really enjoyed, McDonald's. McDonald's is something that at the time, 6 months ago, was a no-brainer. McDonald's is everywhere. McDonald's is what everybody loves. I know a lot about McDonald's, and I know a lot about their business model. I have faith that McDonald's will continue to be a part of our daily lives like it has been for the past X amount of years. So I put plenty of money into that. Then I started putting money into things like Microsoft. Then I started putting money into things like a couple of ETFs that I found that were pretty safe and also paid out a good dividend yield, like SPHD and SPYD. These are pretty commonly known, and for the most part, they have a pretty high dividend yield and they are not too volatile, meaning that they don't go up and down in price like crazy. An example of something that is extremely volatile is something that people have come to me and asked questions about: Bitcoin. No, don't get Bitcoin. I cannot recommend Bitcoin at all. I know a lot about cryptocurrency, and I know that Bitcoin is something that has done well because of hype. It's not doing well because it's a good business model. There's no profit there. So the only way that the actual value will go up is if more people want it. At the moment, not a lot of people want Bitcoin. The reason Bitcoin blew up was because all of the illegal things were done with Bitcoin. At the moment, there's a big change in that. Bitcoin has gone down a lot lately, and who's to say that it's going to go back up? I don't know. There are some people out there saying that it's going to skyrocket very shortly, and there are some people out there that are saying that it's going to go down to zero. I want nothing to do with that because there's no actual business there. Things that you should be looking at are good businesses that continue to make money, have good service, be a part of our daily lives, things that you see every day. So, for example, Johnson & Johnson. If you use soap, Unilever, you brush your teeth, Procter & Gamble. These are all companies that you can invest in right now. If you really like your iPhone and you're somebody who purchases an iPhone every single year, if you're really into the Mac OS, sure, you've already spent over $1,000 a year, so why not pick up one share of Apple? It'll go up. The value of your iPhone will definitely go down. So, that's an option right there for you. If you have the money to buy an iPhone, then you also have the money to buy a share of Apple. An iPhone is a luxury. It's something that you don't need to survive, but yet you still put the money in there. So, instead of putting $1,500 into the next iPhone, why don't you just buy a refurbished iPhone and then put the extra cash into buying a couple of Apple stocks? 2-3 years down the line, that money that you just gained is going to be enough to buy you a snack. But that's money that you wouldn't have had before. So, this is the only way that I can look at it. In the end, the short and skinny of it all is that I can't recommend anybody put their money into the market right now. If you look at any stock right now, you'll probably see that it's down or that the line looks crazy. Nothing is on an upward trend or a downward trend. Everything is on a completely sporadic path. People who are really invested into things like Tesla. I watch a lot of people who die by Tesla and tell you that it's going to be skyrocketing. I personally really do believe that. I believe that Tesla is going to be a huge company. So because of that, I put in $200. I bought what's called fractional shares. Fractional shares are something that can really help break down the idea of investing in general. So, speaking from Robinhood particularly, let's have a hypothetical stock. Let's say that Mike Company is trading at $100 per share. Okay? If you wanted to, you can buy one full share of Mike Incorporated. Or you can buy 10 shares if you really have the money. But for the most part, putting $100 into something that you know nothing about is not an appealing idea. So, with Robinhood, you can get fractional shares. Now, this is not an exclusively Robinhood thing, but it's something that you can do. So, if you wanted to put into something, for example, like Amazon, which is trading well into the $2,000 per share, I don't want to put in $2,000 for one share. So, instead, I can put in $200 and I will get a percentage of a share instead. Okay? So, if I wanted to buy into Mike Incorporated, but I only had $10, then I just put in $10 and I get 1/10 of a share. You can do this for as long as you want, and as the price fluctuates, moving up and down, you just keep putting in the same dollar amount, and the share value will go up. Your equity, meaning the value of your total investments, is always going to be changing. It's always going to be something that is moving up and down. But in the end, your profits, your percentage gained, is still going to relatively be the same if you continually put in. It's much more likely that you will still see gains even if the price is fluctuating. If you start putting in throughout the entire thing, you're going to get the good and the bad. You're going to get the high points and the low points, meaning that if it's trading for $100 and you bought 2 shares, and you also bought 2 shares when it was trading for $50, you're still getting tons of value and you're still gaining something. Your equity will go up. So if you bought into Mike Incorporated when it was trading at $50 a share, that means that now if it's trading for $100, you've gained a certain amount of money, $50 in this case. That is called capital gains. That is something that you do have to worry about for taxes and stuff, but I'm not a tax professional, so I'm not even going to go into that. In the end, the money that you gain is not something that you can just pull a lever and cash out on, really. At least it's something that I don't recommend doing. So if you put in $500 into Amazon, and then the value of the company goes way up, and now your $500 turns into $620. You can sell your share, take your money out, and go about your day. Or you can leave the money in there and hope that it'll go up. Most likely, it'll do a little bit of up and down in the meantime, but after 6 years, do you really think Amazon is going to plummet? Do you really think Microsoft is going to plummet in 6 years? I don't know, but I really don't think so. And that's how you can find a good place to put your first dollar. Put it into a company that you know their business model, and that you understand that they are 1, profitable, 2, well run, and 3, trading at somewhat of a good value. So, these 3 methods are something that a very famous guy by the name of Warren Buffett goes by. It has to have good management. Something like McDonald's. I love McDonald's. I've seen really nice McDonald's, and I've seen really, really run-down ones. I've been to ones that are brand new, and I see how nice they look, and I see how happy the customers are, and I see how great the management staff is. That's great. So it's something that I'm very happy to put my money into. But if you don't know anything about the company, but somebody told you that it's on a trend or that it's going to be going up sometime soon because X, Y, and Z, you have to have a lot of faith in that person because you're going on somebody else's word. What if somebody told you, hey, I want you to dive headfirst off of this cliff. There's going to be water down there, and the water tastes like bubble gum. Are you going to do it? It's like the question, if your friend jumped off of a bridge, would you do it too? It all comes down to the same thing. Just do your own research. Learn the fundamentals. All of these are topics that I've covered on my channel already. Assessing your risk is something that I've briefly touched on. Don't put your eggs in one basket. If you only have $100, you could put that $100 into your favorite company, let's say Amazon. Most likely, your money's going to do pretty well there because Amazon is a good company. But if you put your money into something that some random guy on the internet told you about that you know nothing about and you've never heard of before, that's a dumb investment. If you're doing options trading, that's a dumb investment because I hardly know how to do options trading. It's like making a bet. You're saying that this one company is going to either go up and down in the next 2 months. Nobody can really confidently do that. Unless you have insider information, don't do it. Nobody's ready for that unless you've been in this game for a really long time. Use fractional shares. Put your money into multiple baskets and continue to add on over time. It's totally fine if you can't purchase a full share of a company that you like. It's totally fine if you have fractional shares on things, because in the end, you're still going to see some kind of benefit as long as the money is there. You have to have the money in play in order for it to gain something. So, how much money should you really start with? I'm going to be honest with you. This changes for everybody. Depending on how much money you have available to you, the first thing you have to be sure of is that you can still have money to eat. You can still have money to have a place to live. I know that my bases are covered for now, and that I am at least somewhat consistently finding ways to make money. So, I can put in a little bit more money each week. Some people might not have that luxury. If you're unemployed, no, you're not putting money into the stock market. Don't do that. That's not where your money needs to be going, unless you happen to also be sitting on a couple of grand. I think that a good amount of money to start with would be about $50. That could be a lot of money if it's your starting point. $50 spread out among 5 companies that you really enjoy. $10, $10, $10 on each of them. You're going to see a lot more comforting results than if you were to put in $50 into one company and that company sees a little bit of a tough time for that week. If we take a look at McDonald's for 1 second, you see that in the very beginning when I bought into it, it was on a rise. But then it actually started going down a little bit. And this was way before there was any pandemic involved. So initially, I was a little worried. But because I knew that it had a good business model that was profitable, I held out and I just continued to put more money in. Sure enough, over time, I was still able to not lose too much money. And it also really helped that I had money in other places, so I didn't see a completely sharp drop. All in all, what I can say is, if you know that a company has a good business, then sure. If you're comfortable with putting money aside that you won't be able to use for ideally at least 1 year, then go ahead, do it. If you're able to part with $50 for 1 whole year, go ahead and do it. Me personally, the reason I'm used to something like this is because I actually had to put down $750 on as collateral on my very first credit card. And this is what taught me that idea of delayed gratification in the sense of money. I had to put in $750. They gave me a credit line of $750, and then at the end of that 1 year, they gave me my money back. And then my credit line went up. Really good idea. I talk a little bit more about credit cards in some other videos, but if that's something that you want to know more about, definitely leave it in the comments below. That's all I really have to say right now about investing during these times. If you really feel like you're confident enough, go ahead. But me personally, right now, I'm not going to be doing much investing for the next few weeks. I'm just going to be holding off. But I already have money in. If you don't have money in play and you feel like you do want to do that right now, there's not too much stopping you, as long as you're able to understand that there are many different things that can come into play. Supply and demand will always be the thing that really drives the market, but emotion also plays a really big role. So you can't control the emotions of the entire economy, neither can I. All we can really do is control our own emotions. I feel like I've been able to do that pretty well, and I hope that by you watching my videos, it can at least calm you through a couple of these crazy times. So that's all I really have to say for now. I really appreciate you watching. If you enjoyed this video, leave me a like. If you didn't like it, definitely leave a dislike. If you have any comments on this, you know where to drop that. Check the description below. I got tons of links for you guys to click on. Get your free stock. Join the Zoomer Economics team by hitting that subscribe button, and you get to see where my investments go. So if I lose all my money, at least you get to laugh at me. So I will see you in the next video. Thanks for watching, guys.